Excited to talk to you a little bit about a revolution in investing. I'm coming to you from my home during the pandemic, and I want to start out by talking to you a little bit about RWS Financial Group. So if you know about RWS Financial Group, go ahead and fast forward a little bit to the presentation. But I think it's important for you to understand who we are, what we stand for, all of that. So I'm going to dive in a little bit about RWS Financial Group. We have 8 offices in Michigan. We have 1 in Ohio, and we're starting up 1 in Florida as well. And we've been in business for 35 years. And so we are independent financial advisors. We are fiduciaries. And being independent is wonderful because we don't have somebody on high trying to tell us what we should be recommending to our clients. They don't know our clients. We know our clients. We're independent, and we can do a better job sitting with our clients, listening to our clients, and making the appropriate recommendations. And so we do have a broker-dealer that supports us, but they are an independent broker-dealer. They are probably one of the top, if not the top, broker-dealers in the country, and they give us wonderful support. So they're there to support us, and they do a great job in supporting us as well. One of our foundations is communication and education. I should say 2 of our foundations are communication and education. Last year, we did over 100 free seminars just here in Michigan, and we're going to be rolling those seminars out to Ohio and Florida as well this year. But last year, over 100 free seminars, educational seminars, things like estate planning and investing in retirement and taxes in retirement. So we do a lot of education. That's one of our core competencies. The other core is communication. And so whether the market's up or down, we communicate to our clients. And if you call me, I'm going to call you right back. During this pandemic, I've called my clients, let them know what's going on, how we're going to handle it, that type of thing. So communication is one of our core areas as well. So we're going to get into a little bit of a revolution in investing, and I'm going to talk a little bit about how I've done investing in my career for my clients, my philosophy behind investing in my career. And so here's a little bit of a case study to kind of illustrate. It says the average annual return used by mutual funds to report historical performance is an accurate calculation of growth in value over a multiple year period. And they're questioning that, right? No, that's not right. So you've got services like Morningstar and others that will report the yearly returns. So if you look over here on the left, you might get a report of 8% in the first year, 7% in the second year, and 6% in the third year. And this one's pretty easy because you can tell that the average annual return is 7%. And if you go down here to the bottom, average annual return is 7%. And on a $10,000 investment after 3 years, it becomes $12,249, right? So that one's pretty easy. But let's go over to the right here. We've got up 33%, down 52%, up 61%. And if you add all those together, and that's what these services do, they add all these together, it comes to 42% over a 3-year period with an average annual return of 14%. And if you were to just look at that, the average annual return, you'd say, geez, this is the investment that I want because 14% is awesome over a 3-year period. But there's something you're missing here, and that is that $10,278 is the return on a $10,000 investment. In other words, it went from $10,000 to $10,278. That's not a very good compounded return. So we have to be cognizant of the compounded return. Here, that's only an average of 0.92%. That's the compounded return. Up here, when they're just taking the percents for the given years, they're just adding them together and then dividing by 3 years, and they get 14%. But they aren't taking into account the fact that the investment went down 52% one year. And in order to earn that back, you've got to perform way better than 52% to get that back. If it goes down 52%, you've got to perform it over 100% to even get that back. So, you've got to be. The whole idea behind this is to mitigate the downturns, and that's where I say that's how I've always tried to operate my career in investing for my clients. Is let's mitigate those downturns as much as possible. So whether you're a conservative investor or you're an aggressive investor, we still need to mitigate these downturns, because that leads to better returns, compounded returns, the dollars. And that's what we're in it for, aren't we? The dollars, not what the average annual return is, because that doesn't mean much. In this scenario, it doesn't mean much. 14%, but you're really only getting 0.92% in compounded return. So compounded return is the most important thing. And that's why I say I've always concentrated on my career, my philosophy on mitigating downturns. So with that said, when I sit down to figure out what the best mutual funds are going to be for a strategy, I take a look at diversification, I take a look at the risk tolerance for the client, all those things, and I try and find the best possible mutual funds and combinations as much as possible. But I've got 20 to 30,000 mutual funds to look at. And doing that myself is very difficult to kind of weed through those. So where the revolution in investing comes in is the tool that I now have to be able to help me to put together those strategies. And it is a computerized tool that helps me to find what I believe are the best possible strategies for my clients. So we're going to take a look at the video of that tool, and I'm going to narrate through that. And so let me switch over to that video, and I'll go. And here's the video. And of course, what they're using here is the whole roller coaster thought. So what they're using here is the whole roller coaster analogy, right? So we're going to start that up. And, all they're indicating here is the ups and downs of the market. The market is up and it is down, but we need to try and mitigate that strategy or mitigate those downturns as much as possible. So let me stop this video right here. 1998 through 2018. So this is the period that they're talking about. And they have, in this example, an investment of $1 million in the S&P 500, and they're saying they're going to buy and hold. And so from 1998 to about approximately 2000 is when they hit the peak. The market did great. And suddenly you've grown your $1 million to $1.574 million. And that's absolutely excellent. So I'll start the video up again. And then they had the dot-com bubble, I believe, is coming up next here. So dot-com bubble burst. And what happened to the market? The market dropped hard. Excuse me. And went down $713,000. And then it went back up all the way up until 2018, and when it peaked out again. So it peaked out here, or not 2018, 2008. So it peaked out here again in 2008, 1.6 million. So now you're back up. You've kind of recovered everything, plus a little bit more, and things are good. Until what happened? We had the financial crisis again. So financial crisis hits in 2008, and what happens? The market goes down. And this is not unusual. The market goes up and it goes down. But one of the things what we're suggesting is let's try and mitigate those downturns. Not ride all of it down every time this happens. So, so here again, now we've dropped to $743,000, right? And what happens in 2009? So in 2000, well, we lost the 858,000. In 2009, things start to grow again, and they peak out. And again, this runs through 2018. So they ran this through 2018 in this video. Things were wonderful again, but nobody really knew what was going to happen, right? We knew probably we were going to get another downturn, more than likely, but we didn't know when that was coming. And so here we are in 2020, and you know what? It's happened. And what they're saying here is, why even try to, guess what the market is going to do, and also why ride those super high highs and the super low lows? Why not try and mitigate those super low lows? And that's what this tool is designed to do, or is designed to help me do when I'm putting together strategies. This tool is designed to help me try and mitigate those big downturns throughout the market. And so I'm going to stop the video here again. So we've got a initial investment, and this is kind of an example. This is not a live client. This is an example for the purposes of this video. Again, you've got a client that wants to invest $1 million, and I'll stop it here. They've got a loss tolerance of 10%. So what this means here in this tool is that in a downturn like 2008, where we were down 37%, what the client is saying is, I don't want to experience that full 37% downturn. I'm good with 10%. If we get a big catastrophic thing like that again, can you try and limit it to 10%? And the answer is that this tool, that's the whole purpose of this tool, is we can plug in 10% and then build a strategy that is designed to limit the downside to 10%. Now, is it going to be exactly 10%? No. It could be 8%, it could be 10%, it could be 12%. We don't really know, but it's designed based on 20 years of data to limit this to 10%. So that's what we do. We plug that in. We have a conversation. What are you comfortable with? What's your loss tolerance? And in this example, we've set it at 10%. So I'll go ahead and move that forward. So we've, in essence, built the portfolio here. And we'll let this run for a second, this video run. Stop it here because I want to show you here, in essence, what they're saying is if the S&P 500, which is the overall market, if that goes up, and that's the benchmark we're using, it goes up, we're going to participate in this example, we're going to participate in 73% of that upside. So we won't necessarily participate in all of the upside, but look at the downside. If the market goes down 100 points, we're only going to go down 34 points. We're going to participate in 34 points of that downside. So what we're doing here is we're mitigating the downside so that we can get better compounded returns. That's the idea, the philosophy behind this tool, and that's been my philosophy for my entire career. So I wanted to stop it there and show you that. And so you'll see here as we move forward, so I'll stop it here again. This portfolio in this example is 27% less risk. 27% less risk. and 5.6% more return. Let me back that up just a second. I'll back that up. So we got the less risk and the 5.6% more return than the S&P 500. And isn't that what you want? You want less risk with more return if you can get it. So that's how this portfolio was designed. And then, of course, more capital in the end. This was over a 20-year period. So I'm going to stop the video there. Again, this tool is called Psi. It's for Cyborg. It's short for Cyborg. It's short for a computerized tool is in essence the way they name this. So I'm going to go back to my slide here, and I'm going to make this a little bit larger so you can see it. And I'm going to go ahead and go to the last slide. So again, this was our slide example. I'm going to move my face here if I can. I'll try and move that out of the way. And let's see if I'm successful here. There we go. So we've got our disclosures here. And one of the things that you need to understand, and any time we talk to you about this stuff, is this particular tool uses about 22 years of past data. And we can never guarantee that the past data is going to indicate how you're going to perform in the future. And so you can stop the video and read these disclosures. After you do that, here's how to contact me. If you're interested in this at all, give me a call. I'll give you a free demo, and we can have a discussion, talk about your particular situation, even plug in your data. That's all free. It's a free consultation. We can plug your data into this tool and see what kind of strategy we can build for you going forward with this tool. So I thank you so much for watching the video and listening to me today. Again, give me a call or send me an email. You can also hit our website at rwsgroup.org. There is a button on there to be able to set an appointment. We can do this through Zoom. And so if we're still in this quarantine, you don't have to come down to the office. I can do this through Zoom and show it to you electronically, and even plug your information in if you'd like to do that. So thank you again so much for listening, and take care until next time. Take care. Bye-bye.